Three numbers define expat tax life in Thailand in 2026. 61, 0, 35. 61 is the number of countries that have a double tax agreement with Thailand, including the UK, Australia, Germany, France, Canada, and the Netherlands. 0 is the number of DTAs the United States has with Thailand, not 1. American expats are the most treaty-exposed major Western nationality living in this country, and most of them don't know it. And 35 is the top marginal Thai personal income tax rate, the number that hits your remitted foreign income if you have no treaty protection and no strategy. The gap between 0% and 35% is not luck. It is paperwork. Specifically, it's a tax treaty filed correctly with the Thai Revenue Department. Most expats in Thailand have never read theirs. Some don't even know it exists. Here is why this matters right now. On the 1st of January 2024, Revenue Department Order POR 161/2566 changed the rules entirely. Before that date, only income earned and remitted in the same calendar year was assessable in Thailand. That loophole is gone. Now, if you spend 183 days or more in Thailand in a calendar year, you are a Thai tax resident. And every baht of foreign-sourced income you remit into Thailand in that year is potentially assessable. Every baht, regardless of when you earned it. Think about what that means concretely. If you are a retired American living in Chiang Mai and you remit the equivalent of $100,000 per year from your 401k and investment portfolio, income that your US broker has already withheld federal tax on, the Thai Revenue Department may now assess you on the full remitted amount at progressive Thai rates. With no DTA backstop, no treaty tiebreaker, no exemption clause. Your only tools are the IRS Foreign Tax Credit on Form 1116 and the Foreign Earned Income Exclusion on Form 2555, which is capped at $126,500 for the 2024 tax year and covers earned income only, not pension or investment distributions. You are filing two separate national tax systems simultaneously without a treaty connecting them. Now put a British expat in that same coffee shop, receiving the equivalent income. If that income is a UK private pension, the UK-Thailand DTA makes it taxable in Thailand. But the progressive Thai rate structure and personal allowances can bring the effective rate down to somewhere around 5%, depending on their total remittances. Not 0, but a fraction of the top line 35. Now add a retired German Bundeswehr officer at the next table. He laughs. His government pension is 0 Thai tax, written directly into Article 19 of the Germany-Thailand DTA, and it has been since the treaty was signed. 3 passports, 3 outcomes. Identical monthly income. That is the mechanism, and it's worth understanding precisely. Thailand's network of 61 double tax agreements operates on a set of standardized OECD article categories. Each article governs a different income type: employment income, dividends, interest, royalties, capital gains, and pensions. Your treaty may grant Thailand the primary right to tax a category, your home country the primary right, or in some cases, like Article 19 government pensions, the exclusive right to one jurisdiction with the other barred from touching it. Article 19 is the clause every government sector retiree needs to locate in their treaty immediately. Under this article in the UK-Thailand, Germany-Thailand, and Australia-Thailand DTAs, income paid by a government to a former civil servant, including civil service pensions, military pensions, and public sector employment income, is taxable only in the country that paid it. Thailand cannot touch it. Full stop. For income types that are assessable in Thailand, private pensions, most dividends, interest income, Thai personal income tax runs on a progressive scale, starting at 5% and climbing to 35% above 5 million baht. Personal allowances, spousal deductions, and expense deductions do apply, which is why a British expat remitting a moderate private pension might face an effective rate far below the headline rate. But here is the structural problem with Australia. The Australia-Thailand DTA was signed in 1989, before superannuation as a modern retirement vehicle existed in its current legal form. The treaty does not define superannuation. Thai tax professionals working with Australian clients in 2026 report that the Revenue Department's position on whether super distributions qualify as pensions under the treaty, and therefore which article applies, has never been authoritatively resolved. If your super is classified as a pension, Article 18 likely applies, and Thailand gets primary taxing rights. If it's classified differently, other articles might apply. A 61-year-old Australian in Phuket remitting 38,400 Australian dollars per year, 3,200 per month, is sitting on an unresolved question that could mean the difference between a Thai tax bill of roughly zero and one that runs to tens of thousands of baht annually. That is not hypothetical. That is the operational reality in Australian retirees in Thailand in 2026. And the correct answer requires a cross-border tax professional with specific treaty expertise, not a local Thai accountant, and not a Facebook group. So what does a smart expat actually do with this in 2026? First, locate your treaty. The Thai Revenue Department publishes all active DTAs in English on their website. Find yours. Find Article 18 and Article 19. Note what category your primary income falls under, and note which country gets the primary or exclusive right to tax it. Second, if you are American, treat every remittance decision as a tax calculation. The absence of a DTA means Thailand can assess you without limitation on the Thai side, and your only protection is the U.S. domestic mechanism of the foreign tax credit. You need a tax professional who files both U.S. and Thai returns, simultaneously reconciled, because the two systems interact in ways that can either eliminate double taxation or, if filed incorrectly, leave you paying both. Third, if your income is a government pension under Article 19 of your treaty, document it. The Revenue Department will want evidence that the pension originates from government service. That means payslips, pension award letters, and potentially a certificate of residence from your home country tax authority, confirming you were a government employee. The exemption exists, but you must claim it correctly. Fourth, the 183-day rule is not optional, and it is not approximate. If you leave Thailand before crossing that threshold, you are not a Thai tax resident for that year, and POR 161-2566 does not apply to your remittances. Some expats on DTV or retirement visas are managing their calendar deliberately. That is a legitimate strategy, and it requires actual travel records, not estimates. The 2024 tax year filing deadline has passed, 31st of March 2025. If you were a Thai tax resident in 2024 and you remitted foreign income and you did not file, the Revenue Department's enforcement signal for this year is not ambiguous. Here is the one thing to remember. Your passport determines your treaty. Your treaty determines your tax liability in Thailand. And since the 1st of January 2024, that liability is active, not theoretical, not future, not something to think about when you get around to it. The one thing to do: pull up the Thailand DTA for your country of citizenship this week. Identify your primary income category: pension, dividends, employment income, capital gains. Find the article that governs it. If the treaty says Thailand has the primary right to tax it, you need a number for what you actually owe. If it says your home country has exclusive rights, you need documentation ready to prove it. The difference between those two outcomes across a decade of retirement in Thailand can reach into the millions of baht. The treaty is free to read. The ignorance is expensive. For more on how DTAs interact with Thailand's remittance rules, the DTV visa residency threshold, and the full expat tax picture for 2026, subscribe to the Bangkok Brief newsletter at thebangkokbrief.com and subscribe to this channel so you don't miss the next one.